Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hi, this is Shaily Gang, Chief Investment Strategist at Standard Chartered Bank, India. I am glad to be here talking to you. Today, we'll cover the RBI's announcement on net open dollar rupee positions, that is NOP, made on 27th March, Friday. Some context to it, understanding what exactly is NOP, its relevance in the current scheme of things, and concluding remarks. What did the RBI announce on Friday, 27th March? RBI told each bank to bring down their net open dollar rupee positions to $100 million. Banks need to unwind positions before 10th April. Now the trade is that the banks in India will have to sell dollars on the onshore market as they are long USD onshore, and the banks need to buy dollars overseas as they have been short dollar overseas. Now let us have some context to this. Rupee has depreciated around 11% in the last 1 year and approximately 2.5% since the Middle East crisis began, which is about a month ago as we speak. All emerging market currencies have depreciated against the dollar as they are all net oil importers and net energy importers. Rupee has depreciated the most since we have very high import dependency from the Middle East. We structurally run a large trade deficit on account of gold imports, and we have deep FPI accessible equity market which is prone to outflows. Now there are various tools which RBI employs to smoothen currency volatility. One is spot market forex purchases or sales. This would have high and immediate effectiveness. Other tools are forex and swap operations, CRR changes, reverse repo and repo rate signals. These would work indirectly and are usually medium effective. And there are still others like getting in FCNR or NRI deposits, relaxing ECB norms, etc. On Friday, RBI chose to tighten the limit on net open rupee positions of banks, that is NOP. What exactly is NOP? Let's take a step back to first understand two things: USD exposures in RBI's balance sheet and the segments via which USD INR market operates. India's on-balance sheet USD exposure is via foreign currency assets, foreign currency reserves, gold reserves and US treasuries. While RBI's off-balance sheet USD exposure includes net open positions, forward contracts and currency swaps. Now, how does the USD INR market operate? It operates in two parallel but interconnected segments. Onshore spot USD INR market operates via NSE BSE largely. Onshore forwards or swaps market operates via the OTC interbank, all of which is deliverable and physically settled. The offshore NDF, which is the non-deliverable forward market, is centered in global financial hubs, Singapore, Dubai, London, New York, and it is all cash settled. Now in this background, let's quickly understand NOP. A bank's net open position in USD INR is the net unhedged exposure a bank holds in the dollar-rupee pair at any point in time. It is the sum of all USD exposures, including derivative exposures. Now, if bank's NOP is long USD, if a bank's net open position is long USD, the bank holds more dollars than it has sold. And if the bank's net open position is short USD, the bank has sold more dollars than it holds. How does cutting the net NOP position appreciate the rupee against USD? How would that be? Banks would typically accumulate long USD positions when they buy dollars from exporters, receive FII inflows, or hold forward purchase contracts. Long USD positioning by banks is somewhat seen or could be seen as adding to INR weakness. Now, when RBI has instructed banks to reduce their net open positions, which is net long USD currently, it would force a mechanical wave of dollar selling in the market. Sudden simultaneous dollar selling by multiple banks would increase USD supply and reduce INR demand in the spot market, and this would push USD INR lower, meaning INR is expected to appreciate. Why is tightening NOP limit a powerful tool, and more so now? Unlike spot intervention, tightening of NOP limit would not draw from the central bank's forex reserves, which is all over $700 billion. Currently, it would effectively force the banking system to become the seller of dollars. NOP tightening would be a preferred tool when RBI would want to preserve its forex reserves, and maybe the regulator would want to do it now in the wake of commodity prices rising further. So, rupee surged on Monday morning as expected, but why did it get reversed later in the day? Yes, rupee saw a sharp gain of about 125 paise on Monday morning, but reversed all the gains later in the day, with the USD INR pair reclaiming its all-time high, on Monday at 95.45 to the dollar. That is because the global bearishness was overpowering RBI action yesterday on Monday. There may have been a lot of dollar demand on account of oil price spike up, rush to buy oil as 30-day waiver issued by US allowing Indian refiners to purchase Russian crude oil is expiring on 6th of April. FPI outflows continued and dollar index also strengthened. So let's conclude. As we said at the start, probably the regulator was not looking to defend any USD or INR levels. The central bank was not looking to defend any USD INR levels. Probably it wants to save on the forex reserves for now and set the space for a safer banking system in the long run. RBI is here to smoothen out volatility or any overreaction at any point in time. Thank you for listening in. Have a good day.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.